Welcome to the deep dive. Today, we're digging into just one source. It's an article from The Motley Fool. The title is, "This top Warren Buffett dividend stock is trading at a 5-year low. Time to buy."
Catchy.
Yeah, right? So our mission today is basically to pull out the key stuff from this article about Kraft Heinz. You know, KHC, brands everyone knows, obviously, but also this kind of interesting, maybe slightly awkward connection to Warren Buffett.
Definitely.
And the big question the article tackles, the one we're going to unpack, is this. The stock's at a 5-year low, but it's got this really high dividend yield. So what does the source actually say? Is maybe time to think about buying?
Yeah, and the article jumps right in, doesn't it?
Yeah.
Paints the picture immediately. Kraft Heinz stock, yeah, it's hovering around a 5-year low point. And if you pull back even further, look at the last decade, the stock's lost something like 2/3 of its value.
Wow.
Yeah, it's a pretty steep drop over 10 years.
2/3. Okay, that immediately makes you sit up and go, huh. But like the source points out, that's where the whole Warren Buffett thing gets so, interesting.
Right.
Because Berkshire Hathaway, they're not just, fiddling around the edges. They own a massive chunk, about 27% of Kraft Heinz.
Still, after all this time.
Still. And the article makes it clear this isn't small potatoes for Berkshire either. It's around 3% of their entire stock portfolio's value. So, it's a serious holding for Buffett.
And the source brings up Buffett's own words on it, too.
Mm-hmm.
It mentions he actually called that 2015 deal, the one that merged Kraft and Heinz, which Berkshire helped orchestrate. He called it a mistake.
A mistake? Ouch.
Yeah, but the article is careful to add the why. He wasn't necessarily slamming the business itself. His regret was specifically about overpaying for Kraft back then.
Ah, okay.
And the fact that Berkshire is still holding that huge 27% stake kind of underlines that distinction. The author suggests it's more about the price paid than the company owned.
Got it. So he hated the price tag, but he's sticking with the company. Makes sense. Now, a really big hook in the article, something that grabs your attention, is that dividend. KHC is getting attention because its yield is, around 6% right now?
Yeah, about that.
Which just leaps out, doesn't it? Especially when the average stock dividend yield is maybe 2%?
Yeah.
And it's even way higher than KHC's own 10-year average.
Absolutely.
Yeah.
And this is where the article flagged something really important for investors. When a dividend yield gets up that high, it often signals that the market is a bit worried.
Worried about what specifically?
Worried about whether that dividend payment is actually safe. Can the company keep paying it out at that level? Is it sustainable?
Okay.
So it creates this real tension. They see this super attractive yield, but maybe the market's pricing in a risk that it could get cut down the road.
Right. That's the core conflict. So to figure out if that risk is real, what does the source say is actually causing problems for Kraft Heinz right now? What's going wrong?
Well, the article points to struggles with sales, specifically sales trends going down, especially in the really big North American markets. Seems to be across quite a few brands.
And where's the pressure coming from? The food industry feels like it's changed so much lately.
It really has. And the article talks about this sort of pincer movement they're caught in. On one side, you've got these newer competitors. Sometimes brands started by social media influencers who already have a built-in audience, right?
Yeah, direct-to-consumer stuff.
Exactly. And then on the other side, the source mentions shoppers just being more price conscious. They're willing to trade down from the big national brands to store brands or unbranded stuff to save money.
So squeezed from the trendy side and the value side.
Okay.
And the article says this pressure forces them into price competition, right? Which must hurt their profits.
That's exactly it. If you have to cut prices or run more promotions just to keep stuff moving off the shelves, yeah, your profit margin is going to feel that. The article gives a specific example from Q1 2025. It noted that organic net sales, so that's like-for-like sales growth from existing businesses, fell almost 5% compared to the year before.
Okay, a 5% drop.
But, and this is what the authors seem to find more concerning, their operating income, basically. The profit from just running the business before interest and taxes that fell by an even bigger amount, like 8%.
Ooh, okay. So profit falling faster than sales.
Yeah. And the source flags that trend. It says, look, this is problematic if it keeps going, especially when you think about having enough cash flow to cover that big dividend.
Okay, so yeah, falling sales, shrinking profits, this competitive heat. It sounds pretty challenging. Does the article give any glimmers of hope? Any upside, even if it's modest?
It does. It does. The source does pivot to what it considers the underlying strengths. The first one, maybe the most obvious, is just that portfolio of really, really well-known brands.
Yeah.
The article lists some giants, Kraft macaroni and cheese, Heinz
Yeah.
ketchup, Velveeta, Lunchables, stuff everyone knows.
Household names, definitely. That brand recognition must be worth something, even now. What else?
Well, the article mentions management is looking into strategic transactions.
Corporate speak for.
Yeah, basically means they might be looking to sell off some parts of the business or maybe buy some others.
Okay.
But, and this is a big but, the source immediately ties this to a major constraint: their debt. They're carrying a lot of debt, almost $21 billion.
$21 billion, wow.
Yeah, so the article argues this kind of limits how big any acquisitions could be. And it suggests that to really make a meaningful difference to that debt pile, they probably have to sell off a pretty major brand, maybe one they wouldn't ideally want to part with.
Okay, so the debt really ties their hands strategically, according to the source.
It seems to. But the article also highlights something positive on the operational side, a strength that gives them some breathing room. Despite all the challenges, the company still manages to maintain what the author calls a stellar operating margin. It's around 20%.
20%.
Yeah.
Even with all that price pressure, that's pretty good, actually.
That is, yeah. Especially in the consumer goods world. So that strong margin helps support the business fundamentally.
Okay.
And the article also mentions management has a plan. They're aiming to cut operating costs by about $1 billion by the end of 2027.
$1 billion in cost cuts.
Right. So that's another thing the author sees as potentially helping to, stabilize the ship and support profits. Which, again, it's good news for the dividend.
Okay, so putting it all together, all these different pieces, what's the author's final take? How do they balance these competing points?
Well, the author's perspective, basically, as laid out in the article, is that you probably shouldn't expect huge growth from Kraft Heinz.
Yeah.
They use a pretty direct quote, "People only eat so much food."
Fair enough.
So if you're an investor primarily looking for big revenue growth, or even for the dividend itself to grow significantly, this stock might not be the right place to look. The author definitely acknowledges those negative trends we talked about, the sales, the profits, they exist, and they could, if things get worse, eventually threaten the dividend.
But they still landed on a much more hopeful view for income investors, despite those risks.
Yes, exactly. That's the crucial part of their conclusion. Despite those headwinds, the author ultimately believes the dividend is probably safe, if your main goal is just collecting that current income.
And the reasoning for that hopefulness is?
It comes back to a few things we touched on. The sales drops, while not great, have been relatively modest so far. And those strong, like 20% operating margins, plus the plan to cut costs. In the author's view, that combination provides enough profit, enough stability to keep covering that dividend payment, at least for the foreseeable future.
Okay, I think I get the picture the source is painting. We've got this company, Kraft Heinz, huge brands everyone knows, this major connection to Warren Buffett, even if it's complicated. It's trading at a 5-year low, which catches your eye, and it's throwing off this really high dividend yield. But on the flip side, it's fighting against falling sales, competition is squeezing profits, and it's got this massive pile of debt.
Right.
Yet it also has those solid margins, plans to slash costs. And that leads the article's author to say, hey, if you just want income, that high dividend is likely okay, despite the warning signs.
That sums up the push and pull in the article really well, yeah.
So it leaves you, the listener, with a fascinating kind of puzzle, doesn't it? The article points out, look, a super high dividend yield like this often acts like a warming flare. It signals market doubt, screams risk. Maybe the dividend isn't safe.
You should, yeah.
But then the author digs in, looks at things like those strong margins, the cost-cutting plans, and concludes that this specific high dividend is probably all right for income investors. So given these conflicting signals, the yield flashing danger, but the author feeling it's safe based on fundamentals, what questions does that bring up for you? How do you personally evaluate a dividend stock in this kind of situation? How do you weigh a market signal, like that high yield, against company-specific factors like margins and debt and management plans when you're trying to decide if a high yield is actually a red flag or if it might be a genuine income opportunity? Something to think about.